Welcome back. Today we're speaking with Jason Birnboim. So he runs Beaux Properties International. They have 50 employees, 25 years of experience in real estate. They have properties in Toronto, Ottawa, Calgary, New York City, LA. So he's well diversified across North America, and they have thousands of units. So not only did they acquire them, but they actually do all the asset management as well, and they look after their buildings. So they definitely have their finger on the pulse. Jason, welcome to the show.
Thanks very much. I can tell you who would know more than me is my father.
Well, let's go back to the origin story. I know we were chatting a little bit and we got going there with real estate chat. It was like 20 minutes in. We're like, we got to press play. So where I stopped you was you were actually explaining a little bit about your grandfather. And so he started, I believe, is out in Winnipeg. And maybe you could go and start like the origin story of the family and then kind of work your way up to today, if you would, for yourself.
Absolutely. Yeah, my grandparents were hardworking immigrants who landed in Winnipeg in what would have been the 30s, I believe, and before the war, possibly the 20s. And they sort of struggled, but got by. And with what they had saved, they would acquire. My dad would call them schmatas, which means sort of rags, but they were essentially storefront walk-up type properties that my grandfather would, through his own labor, because he was a expert plasterer, and I think he did cement formations and concrete work as well. He would help repair things and cut costs that way. So they were able to accumulate a little bit of wealth there. Eventually, buying more apartments, and they lived quite modestly and frugally, but they were happy. And my dad and two brothers, his older brothers, were medical and professors, scientists. My dad had a knack for the business, just like actually my grandmother. And in the 60s, they decided to venture into apartment construction, and they built a mid-rise building that still stands today. My dad was very involved at that point. He's probably in his late 20s. He returned to Winnipeg from Western University, Western Ontario at the time. They call Western University now, with an MBA and a chartered accounting degree. And it sort of grew from there. He was a practicing chartered accountant for many years, and eventually his sort of side deals of apartments, of real estate at least in Winnipeg, took up way more of his time, and he decided to devote full time to that activity. Moved the family, including young me, to Toronto in the late 70s, and from there did a lot of investing in, again, exclusively apartment buildings, primarily since 60s vintage concrete, high-rise underground garages, balconies, that sort of stuff. Um, and a lot of flipping in the early 80s when there's a lot of inflation. You could flip a building for, $1 million in 90 days or whatever it was, just crazy numbers. And eventually he settled down when he felt he could afford to to own and maintain and pay down the debt on a prime property. He did so, and in around 1984. And really from there, it's just been straight up. Essentially, the market here corrected dramatically in the early 90s. He wasn't over leveraged, so he was able to acquire more in that instance through a close friend who became a partner, is still a partner from the early 90s. And we just grew from there. It was almost exclusively apartments because in my dad's sort of immigrant mentality, or son of immigrant mentality, anything else was not essential and too risky. So they wouldn't even buy a building that had retail at the base. When I moved to New York in 1994 for law school, and I was poking around from what I'd learned from my dad, hey, maybe we should buy some buildings in Manhattan. He didn't want to touch anything that had retail at the base. It sounds crazy. So I went to law school in '94. Yeah, and I lived in New York for 7, 8 years, practicing attorney for a little bit in New York State. Of course, I did real estate finance. Did another degree at NYU in finance, and then found my way back here in 2002. Is that right? 2001, and joined my dad in 2002. And again, it's been straight up since there. A few bumps along the way, but we never really over leveraged what we did. So no one deal could break us. And that was kind of been our philosophy.
Oh man, what a great story. So there's a couple of things I picked up there that you guys did. Was you guys actually went away for school and you got educated on the finance and the accounting side, like your dad being an accountant. that would have given you such a competitive advantage running these buildings as well, right? Having that understanding with you with the law degree as well, and finance. How much did that help with your overall growth? Was that valuable for you guys as you guys continue to grow and scale your portfolio?
I mean, it's really interesting looking back now from adults' eyes on what my father was able to execute. Because as a child, I viewed it as, I wouldn't say effortless, but almost like there was a path that he was just following that was working and would continue to work. But at the end of the day, it was enormous discipline. And as kind of a solo operator, you mentioned entrepreneur a few times. Still, how I think of our company and myself and my dad, yeah, I mean, he never got over his skis, So knowing the numbers as well as he did as an accountant, knowing where there were tax loopholes to help in the real estate industry that mostly still exists today, although not entirely in this country where we have our regulatory challenges and our you know, socialist essentially philosophies that essentially flow through to most of business operators in this country. Even given that, yeah, it made a lot of sense for him to apply his accounting background to the acquisitions. But I think the I mean, listen, we're a Jewish family, and the word mazel means luck, and that sort of permeates every aspect of life and business. And I always think business is probably, you know, 10% skill, hard work, and 90% luck. Certainly timing.
Yeah.
But unless you apply that skill and hard work, effort, at least with full effort and with focus and discipline, you're not gonna succeed. So, and by the time I joined him, he'd already had a plan in place, and again, I was able to help the company navigate a different direction as far as development goes because we hadn't done a whole lot of that, and that sort of took off in its own right. But we went where the opportunities were. I'm more on the retail side, and there, a lot of good war stories from retail development. I learned from a former partner and people in the industry, but it's a lot of it's changed today.
Mm, so good. So your dad found kind of a hedgehog concept, like he loved apartments and he just used that head down discipline, knew his numbers, and stayed focused on that. Now that you've kind of gone in other directions, so like the base was the existing buildings, you go and buy them. You had mentioned a number of them. You've gone and basically turned them over, where they're basically brand new units. You've gone into retail. You've gone into some new development. Looking back on all of that right now, what advice, or would you do it again? Would you continue staying in the existing apartment space, or would you go more into the new development, or would you go more into the retail? What advice would you have for the listeners today in regards to kind of like focus and going in multiple different directions or not?
Up until, it's a great question. Up until, I guess, 2022, 2023, we really were in, a 20-year bull run for the bond market, and interest rates and cap rates fell in lockstep, and so many deals were rescued by that. A refinancing boom. I can think specifically two periods. In the pre-financial crisis time, and then pre-COVID, essentially, and then obviously during COVID. But even so, like cap rates just rescued you. And when it comes to development, you need a laser focused team that is completely oriented to all the local industry practices and local industry dynamics to succeed. At least from our vantage point, having worked with one of the best developers in Canada, Tridel, if you know the name,
Yeah.
and they, I don't know how many tens of thousands of units they built. So I can see that as a developer, that's the only way it works. And then so when you're doing development, to me, real estate development is hardly real estate. It's like manufacturing of real estate. It's you're making a car, you're making an iPhone, but the end product is more scarce. But there's all those aspects of it, and obviously critical time constraints that are involved. So to that end, you'd have to have that personality in the development space. I mean, certainly there's some amazing world class developers in Toronto that you can learn from or work with. But if it's not per se so entrepreneurial, and it's extremely difficult to enter. I've
Mm,
always felt that, and on the retail side, we were successful because you can get away with some smaller projects. You can pre-lease projects a bit, but we were rescued many times from just declining cap rates. That made the bad pro forma look better in retrospect. But again, we tried to mitigate all the risks with the pre-leasing, zoning, having financing lined up, and if someone wants to bring me a retail development deal, I'll have all day to look at it. Especially if they're good tenants. So, but starting out, I mean, I have a young cousin starting out and buying units all over the place, and he doesn't live in any of the markets where he's doing it, but he seems to be getting positive cash flow. But he's bringing the hustle, for sure. And I think his position is rates are going to come down for her. I don't know. To me, that's a risky move, but you never know.
yeah. So when say somebody's starting out a real estate investor today, uh, like you had mentioned, so new developments kind of tougher to get into. Where do you see if you're going to give advice for a brand new real estate investor today? Maybe in we'll to make it easy, we'll make it in Canada. As a
Sure.
Canadian out there, they're like, I want to grow my real estate portfolio. They look at a guy like you, and they're like, oh my goodness, this guy's like in the all stars of the NHL. We were talking hockey earlier, right? So how like, and they're like, wow, that's amazing, but maybe just we'll say to a piece or like a small amount of success in real estate. Where's the opportunity today that you see?
I think it's a balance. I mean, you have to really consider what's my game plan, my long term objective. If it is building wealth, I think you'd have to create a vehicle that can sustain itself in bumpy markets or turbulent markets, where you can generate enough of a income, call it a fee income off investors, or yield off whatever capital you have to ride things out. But then over time, in a Canadian market, a Canadian city, and every time they talk about Canadian cities, I laugh because to me, there's Toronto, there's Vancouver, there's Montreal, and there's a bunch of smaller markets. To be honest, right, compared to the states. I don't know how many others. Are there any other cities over a million? Probably not. So, or certainly close. So, if you're going to do it at scale, those are the only places you can really do it.
Mm,
But if you've got a structure where the pro forma yield on the investment is sufficient to satisfy a pool of investors, whether it's institutional investors or friends and family or high net worths, and you can carve out yourself some sort of income stream that's sufficient for you over time. I think it'll pay off. We're at a precarious time right now, if you have to be honest, in certainly in Toronto, and I believe in Canada as a whole, because immigration projections are down. Like we perhaps overdid it a bit, although you won't hear me say that because I'm a landlord and I want as many new immigrants as the system can handle.
yeah.
But it all it all depends on new people coming into town, and for Toronto that's worked, and Vancouver, really well for a long time, and now we're at a bit of a pause. I think it'll work itself out after a few years, but there's a big glut. So you got to be opportunistic for sure, which you'd think people would be in this market, but I'm not seeing a whole lot of deals. So I don't know. Getting in, I think you should position yourself for, hey, how can I learn from this turbulent scenario, from people that have been through it, and maybe find myself in a position to work with people like that, and then build your thesis from there. Uh, at the end of the day, to answer your question, what my family was able to do, I think, was really opportunistic.
Yeah.
At the time. And I heard on a prior show you mentioned the challenges of rent control. And the truth is, if you did interview my father, who's still active, he feels as though he thrived in spite of rent control, or because of rent control, because there was a bit of an arbitrage. Similar to now in a sense, like if you put the time in and did the work, you were able to get a really good return on your additional equity on your building through rent increases. But you have to go to the tribunal and justify the increase, for the capital work, and So when he first started doing that, and it was to your earlier point about being an accountant, and also in that era, people were just really turned off by apartments because of rent control. So they said, we've had enough of this. We're going to go build office buildings downtown. And in the late
Right.
'80s that worked well, but people didn't want apartments.
Yeah.
So
Well, it
it's
turned out,
cyclical.
yeah, it turned out like the apartments there, that was a good idea, compared to going into the office space, especially recently. Um, so it's interesting you say that, because we, as a broker, so north of Toronto, we would have thousands of investors come to us, and it was harder to find cash flowing deals, because that's where I found, like, especially turbulent times, like one thing, and I want to talk about leverage with you in a minute. That's something you guys did so well. So there's a message there. But when I started looking, like kind of further outside of our local market, I'm like, where in North America? And then I started finding down south that there's some really phenomenal deals down in the kind of the southern belt, like Atlanta and Charleston and Tampa area, affordability and whatnot. And but what I found was, in order to run the larger, like 100 unit deals, you need to build a team. In order to, you could, that's not just a one man show. Like, you need like to recruit. And so that's where, for me, in order to continue to grow, it was like I did what you had suggested earlier about building like a team for it to be able to execute on this. That's what we did. And so the only way we could build the team is if we could help other investors invest in these larger deals as well. And so that's what we did. And so we built the sister company, Faris Capital, and where we take these apartments down as well. But yeah, the aspect of looking at, okay, how can you still make it in the market? For me, what was really interesting is sometimes you have to go outside the market. Like, you're in New York and LA as well. Like, so you're pretty diversified across. Sometimes have you found that you had to kind of go into maybe a different market to get the kind of yield that you wanted, or was it just, are you still finding deals today?
100%. That's exactly right. I mean, diversifying into America was something that we sort of had discussed, as a family entity a long time ago. I mean, it's no coincidence. I lived in New York and I lived in LA briefly, so I know LA pretty well. But these are also, guess what, the biggest cities in the country.
Yeah.
Um, Now that, and they're also arguably too big to fail, notwithstanding both of them have their own challenges. The entry point in LA, I think, was attractive in 2023. So we made the biggest acquisition with our partner. We had a smaller one previous to that, but the thesis was, hey, look, LA's a bit down on its dumps, didn't recover too much yet from COVID. Things should improve. Have they improved? A little bit. It's been rocky. It's still but it's one of those markets with gigantic barriers to entry. In New York, even more so, and even crazier regulation. But our entry point in New York, I won't go into details, but we bought 450 units in Queens. And, the price per unit was a 2017, 2018 price. In fact, it was probably a price that was, I shouldn't say that, it was probably 40% less than that value because the market is just obliterated. So when people said, aren't you worried about regulation, rent control, all this? I said, of course, but our cost basis is so low. Our
Yeah.
partner is so tight on his operations that it should be pretty good yield. So far, so good. But, you mentioned, there's no market that I would like to invest in more than Florida. But from my vantage point, I don't know Naples very well, beautiful spot. But from, the East Coast, everything I see is priced to perfection. And, you got insurance risk, obviously, you've got real estate taxes. And now it seems to me a vacancy is really hitting home with a lot of new supply on the east side. So that those are factors that scare me a little bit. And, and it's also very cyclical. So, but I think from a chalkboard exercise, look at the politics in Florida. I mean, they are
Yeah.
just welcoming people with capital, with a business mind, who don't like regulation and freedom, whatever that means. Come to Florida, come to Tennessee, I think, obviously Texas. These are great markets. I'd love to, but I would only do any of those places. Florida, maybe I do independently, but the other ones with a guy with boots on the ground, like yourself. because, that's where the mistakes are made. My grandfather used to say, the best way to lose money is to find this, invest it from far away and give someone your money and, cross your fingers. Like, you absolutely need boots on the ground.
Yeah, 100%. Yeah, it's interesting. We have and that's what I found as well, because actually the first two times I read this book, Jim Collins talks about fire a bullet before firing a cannon. And so we brought checks into two different groups down there. And I saw that firsthand, what you just said about like boots on the ground, one, but also not having like decades of experience in specialized, like rather you have one guy that does everything and you got a bunch of guys that are kind of generalists instead of specialists. And I found, like, growing my first company to like 100 team members, I found that you can go and hire specialists that are way better than you at doing the one thing, in the sense that, there's acquisition, underwriting side, and then there's the asset management side. And so there's an understanding that you still need to know. But when somebody does it for a decade and they're working at like $1 billion portfolio and they're the senior guy making those decisions, if you can extract that and build your own team, that's where I found that you get a major competitive advantage. Like, so this is where I like what you're doing about bringing everything in house, because you have control, you can manage it, but you can set the high standard of it. But Tampa, Largo, actually, we got 104 units there at $218 a square foot. But what was interesting is
Great.
Charleston, we're picking properties up at 127 to 147 a square foot. Like, these are garden suites. And then Noonan, we got 114 units, $169 a square foot. So the only reason I'm sharing that is but those are like 1 in 300. Like, you had to go through 300 deals to find the one. And the only way you can find those is if you have guys boots on the ground that are actively hunting every single day, going after it as well. So going to your cost basis, if you get at the right, if you buy it right, that's why I like what you did in LA, New York. Like, geez, like, the cost here for buying is like that cost basis. It's going to be hard to lose as the market, you said, cyclical, right? When it comes back, you're going to be well positioned regardless.
Yeah, and interesting. You said Charleston. Am I corrected? Is that the Space Coast, or is that the market? Because I believe someone sent me a deal there once. It was very impressive.
South Carolina,
I know it's in South Carolina. Is NASA's
south,
not there? Maybe I'm thinking of somewhere else. But I read an article about Charleston very recently. I think it was in the Wall Street Journal, and it was such a green light. And I forwarded it to somebody, and I'd seen a couple deals there, and it seemed like the kind of place, provided you have people there that you can trust, that really checks a lot of boxes as far as new growth goes, and certainly politically. And that's the kind of market that would certainly pique my interest if I had the right partners there. um, but you talked about cyclicality, and it's interesting because I was having a discussion. I believe it was a YPO person, but I'm trying to remember how I got connected to them. But they're a Florida person, and we were talking about deals. And he hasn't been buying a lot recently, but he's very successful. And he was saying, we were talking about cap rates and positive leverage. He goes, I don't need positive leverage. I just need a path to profitability. And I said, so what that it's 4%? I can get the rents higher because the market's higher, and I know how much work it's going to take. And I said, unless it's that obvious, where there's no rent control and the markets are $500 below market and
yeah,
the
yeah.
units are in good condition. Sorry, like, I mean, I get it. You got some empty units, so maybe give them some credit for that. If it's 10%, building 10% vacant, markets 5%, okay, give it some credit. To me, I want positive leverage out of the gate. I'm sorry. I mean, that's how you buy real estate, if you ask me. Otherwise, you're just, you're rolling the dice, and it doesn't matter if you're all cash or 90% leverage. You got to get a better than bond return on that kind of risk asset. Is my thing.
Can you explain it just for the listeners out there? Because I understand, but can you explain what you mean by positive leverage, just for the listeners that they have context?
Yeah, absolutely. I should tattoo it on my arm. because it's so
Well, it's
important.
working. Whatever that's working for you. So there's we should be. Everybody should be listening right now to this.
I mean, it's just so important. So essentially, any risk asset is priced relative to a risk less asset. I learned that at NYU from a very knowledgeable professor who was there. It was all adjunct in those days. But I mean, everyone knows that instinctually. But so if you're going to take risk with your capital, you need to generate a return pro forma, but conservatively, that's better than a bond, and better than, a mortgage bond. And certainly if you're buying real estate. And again, absent some very obvious turnaround scenario, as I suggested, well, of which there are many, mismanaged. It's always a story that, oh, it's mismanaged, right? Okay, fine, but let's really look at what's going on. My assumption whenever I see a property for sale is that the seller's the smartest person I've ever met, and he's trying to scam me somehow, and it's my job to figure out if he is, or if he's not, what the real situation is with the property. And you never know, but,
Yeah,
because, if they own a 20, 30, 50, $100 million building, they're no fool. I don't care if they're managing it, third party managing it, whatever. So if you're going to buy that building and the cost of money from Fannie or Freddie is 4.5%, plus some sort of amortization. Pick your term; it doesn't matter. I'm not as concerned with the amortization, but if it's going to cost you 4.5%, to me, the yield today, the NOI, the profit as a percentage of the purchase price should be greater. And if you're institutional and you're an institutional advisor and you're getting paid to deploy money, you're going to make that work. But if it's your shekels, your own money, you're going to be damn sure. And I guess it can be close when interest rates got so low. In Canada, you were borrowing for 5 years for 2% maybe, right? And long-term amortization. So people were buying buildings at 3.5 cap with upside. I didn't do deals like that, but it kind of made sense. I sort of understood the philosophy. There's some massive advisors, I won't mention their names, but biggest in Canada were doing that aggressively throughout that cycle. They did great. But what I find now is that everything's reversed. The Fed went crazy, jacking up rates. In Canada, it's come down a little bit, but so the cost of money went through the roof. And those deals that were 3.5 cap, now they're maybe a 4 cap, but the cost of money is 4.5. And so in large measure, deals aren't selling, but everyone's got a story. So you just have to be extra, extra careful. I think you always do. But another catchphrase I always say is, in my opinion, today, I think we're similar generation, but I often think back to previous times, like it's a little different from the entrepreneur versus the institutional capital. But in real estate, today people get paid to raise capital and deploy capital, but not necessarily to make capital. The make capital's down the road, and you're going to get a piece of the action, a promote, or whatever you want to call it, an earn out. But you're really getting paid to, which is a skill, but to raise that $1 billion fund and put it out there. Well, with your money and my money, that's not good enough. We want to be sure that unless COVID-2 comes, which is maybe AI is the new COVID for real estate, who knows? But unless COVID-2 is coming down, you want to know you're going to get paid, and you're going to get paid more than the cost of money. So
Hmm.
anyway, that's my spiel. Hopefully it made sense.
Yeah, no, that's really good context there, because basically whatever the interest rate is you're going to be paying out, you want to make sure that your overall net operating income, or say your cap rate is going to be higher than that. So that's just like a straight, we'll call that a like a decision filter at the end of the day, to be able to qualify deals. And like I get it in regards to the lift side of it, because you go in and you can change that very quick. You can go in and flip it and raise rents. But I get it
Sure.
from an overall assessment standpoint. It's good to have these set rules and filtering mechanisms, which you guys have done extremely well. So I think anybody would be wise to listen. The leverage side of it. This is a big one I want to just talk about. I want to make sure before we get into the rapid fire that leverage is a really interesting thing. And I've seen over the last few years the operators that were low leverage, and they locked in their rates. They had they didn't have like the adjustable rate mortgages, and they didn't max out leverage. those guys were the guys that continue breathing and living, and the guys that are adjustable rate mortgages, they maxed out their leverage. Um, Interest rates double, all of a sudden they're underwater. And there's a lot of operators now where the banks have been kind of pretending and extending, where they're saying, okay, like you need to sell right now, and there's some losses happening out there in the marketplace because over leverage. What filtering mechanisms, like when you guys were purchasing them, is it just like you buy them at low leverage and then just pay it off as fast as possible, or what's kind of your philosophy to be able to protect yourself moving forward, regardless of the market?
Yeah, I mean, you explained it perfectly. And again, it goes back to my earlier comment, I think, about strategy and structure and capital stacks and how does your organization function? So yeah, if you're an advisor or you're a fund, you want to portray the highest return, the lowest risk, and getting the money back as quick as you can, I suppose, right? And that makes sense. I never look at an IRR, to be honest. I look at the unlevered yield, and as we discussed, because and I can't look much beyond where we are today and the market today. Everyone promises you're going to make a 150% return in total on the cash and a 12% IRR, 15% IRR, and isn't that great? But I said, okay, what's the risk? And you can always manipulate the numbers through different amounts of leverage. And prior to the interest rate cycle reversing, people were using a lot of mez debt and pref-x and pref pieces, et cetera. So no, for us, I mean, with private money, honestly, the last several deals we've done have been very low leverage, 50%, and enough that you can withstand a big shock and get cash flow. And that's us and our partners. And with the I guess on the new acquisition side, yeah, the concept would be, yeah, if you get the NOI up, you can refi out a lot of the equity you put in, and that's definitely a prudent approach for underwriting an investment. But you have to be prepared that that's not going to happen. You have to be prepared that you're satisfied with the cash on cash returns going in, and not necessarily expect, hey, I'm going to double my money. Especially, I mean, I don't think anyone out there is saying, hey, look, mortgage rates are 4.25, 4.5. I'm trying to think the last one we did. I think it was 5.15 was what, whatever that was a year ago, around something like that. That's the cost of money. No one's going to say, my deal only works if it goes down to 3.5. I mean,
Mhm.
you might as well speculate on the bond market. It's a lot
Yeah.
easier, so nobody knows and no one can tell you. Um, so in that respect, unless you're buying, a retail property as an example with a grocery store that has perhaps options and it's kicking in next year and it's significantly more. So then you take floating rate debt, you assume they're going to renew and, boom, then you take all your money out when they renew at a higher number or something, which doesn't happen often, right? But I mean, listen, we love single tenant retail. I got, in the States, Dunkin' Donuts, I got Tim Hortons here, I got Metro here, I got groceries, I got, drugstores here, franchises. That stuff pays the bills for sure, and it's in high demand now. I think some people would argue retail is hotter than any other sector, although to me it's just the cleanest shirt in the laundry bin. So because real estate's taken a hit as in the last little while, certainly in Canada. So anyway,
Got
I
it.
think I'm expanding more than you're asking, but yeah, that's how I see things. Leverage can certainly make or break you, and in our instance, in our scenario, it was from our capital and our partners. Let's pay down the debt, and inflation has been kind to income producing real estate over decades. Um, back to your question, how do you get started? I don't know, and I don't think you guys know either. You and your partner. I don't know too many people that got rich in real estate overnight or over a year or over 2 years. It's been a process, and full credit to you to building a brokerage and overseeing a team like that is, you know, my employees do a hell of a lot of work that bail me out of problems all the time, right? But at the end of the day, I can open the door and be 96% full, 97% full. So they help me be 99% full. But in a high barrier to entry market like Toronto, there's just natural demand there. You got to generate those sales, so that's tough.
Yeah. No, there's a lot there for sure. And I think that is like you guys have withstood the multiple down markets. And Dave Ramsey, he's really big on, you buy real estate and pay it off. Buy real estate and pay it off. And I think before the peak of the market at 21, where we saw the drop, how interest rates rose so quickly. Before, I think that was a little bit more kind of far fetched. Like, why would you do that? Like, you can leverage it, um, but all of a sudden, after interest rates doubled, the guy looks like a genius. Or it's like, oh, geez, like now he's holding his real estate still, and like sounds like what your dad did was when there was a peak, where's a lull, he continued to buy at like crazy discount. He was ready to buy when the market came down as well. What are your
Well, he
thoughts
was
on that?
opportunistic in the
Yeah,
early. I can't recall if you were in Toronto or Ontario in the early '90s. It was, in my opinion, way worse than now. I mean, now things in
yeah,
again Toronto, Ontario are weak, but the job, and the job market is weak. But in the early '90s, it was people were decimated,
yeah,
and
yeah,
let's hope we're at the bottom now. But so now it's really, to me, just a question of price. At the right price, people will absorb all the unsold condo units. For our listeners, Toronto is undergoing a massive glut of new condo completed inventory and a complete cessation of new pre-sale condo developments because of it, and a bunch of factors. One of which being our esteemed federal leaders, who I am not a big fan of, have shut the doors completely on allowing any foreign entity, a foreign person, to buy real estate in Canada. So if you're an American, you can't buy a condo in Vancouver. It makes zero sense to me. It's not going to make condos more affordable in Vancouver, but that's our policy for the time being. It really hurt the market. But in any event, you want to be opportunistic, but at the end of the day, being cautious pays off, and being so does being opportunistic, and leverage is a massive part of it. And Dave Ramsey's absolutely right to paying down debt can be very rewarding, especially when you've completely cleaned up your balance sheet, and it's just all the bottom line, and it makes it easier to withstand the shocks. And COVID, you talk about the COVID boom, but I mean the first few months of COVID were obviously panic for everybody. But so in our case, it was about a year after. So call it the winter, spring 21. All of a sudden, everybody left Toronto. I've never
mm,
seen this much vacancy in my life. And I've been exposed to this business my entire life. And New York was worse, by the way. New York was probably 20% vacant. And there didn't appear to be an end in sight. It appeared that everybody thought they could leave urban areas, Toronto being just like New York and San Francisco, possibly LA, I think a little bit. Just go live remotely in some beautiful smaller market at a quarter of the price, and not rent for me anymore, and buy a home or whatever. And so that took a good year of us throwing massive incentives just to keep the lights on. And it
right.
was it was scary, but again, if you have a clean balance sheet in those times, you can withstand it. And that's how you got to structure yourself. So but that's how we approach pretty much every investment, from the perspective of, can we withstand those shocks? May not result in the best short-term return on your equity, but over the long term, you survive. Maybe you're opportunistic. And again, with inflation, I was just looking up some numbers before this. In 1980, the average home in Toronto was $88,000, and you know city of Toronto, a single family home, it's probably close to 2 million today. So take 88,000 and 20% down. So conservatively, you put $25,000 down in 1980, and you might have a million and a half, $2 million in your pocket now, tax free, if you sell it. To me, that's way better than. I'm not advocating go buy every home at every price, but that's inflation, right? So the market is telling us, look at the price of gold. It's telling us inflation or at least devaluation of money is happening. So I think that's the right approach.
Yeah, 100%. Uh, Curious to get your thoughts of where you see the future. I know there's probably, listeners like, I wonder what Jason thinks about what's coming down the pipe. What's your read in regards to, I know nobody has a crystal ball, But what do you see kind of the next kind of 1, 2, 3, 4, 5 years kind of look like?
Well, again, we have a huge bias for urban real estate. Over time, it's paid off. It's had, a lot of societal unrest in the urban areas, in the big cities, in New York and LA, to some extent Toronto. So those are headwinds. Potential regulations a headwind. But I think if you can look, say, 10 years in the future, hard to imagine that in an urban market like Toronto or New York, that you don't continue to see growth because you've got, ultimately employment, AI or not. I read a good Goldman Sachs report today, by the way, that sort of muffled a little bit of the fears on AI and saying it's certainly going to affect a lot of industries, but not nearly as they don't think as much as people fear. But I always say apartments are the last shoe to drop, and urban apartments, even more so because it's a place for people to live, so they can theoretically work from home in their urban apartment, and they want to be near amenities. And in the big cities, you've got the universities, you've got the hospital systems, certainly in Canada. It's all here. You've got all the entertainment, the amenities, and and the sports. Don't discount how valuable it is to have Leafs, Raptors, and Blue Jays, or Tampa Bay Rays, or the Lightning that seem to always win the Stanley Cup. You know, and
Yeah.
football teams. I mean, that's where people want to live, not rural. So I would think, again, look out in the horizon, um, risk adjusted and comparatively, hard to imagine that a well maintained, and you mentioned, your partners in South Carolina, well managed, well situated, income producing real estate assets, such as an apartment building of scale, is not going to outpace other investments, both on the return and the risk. Uh, Basis, but it's a bumpy road. So be prepared. The interesting thing about real estate versus mark to market securities, everyone's stock market's been on a run, but you can't, you can't mark to market your apartment building every day. I mean, you may in your head, but certainly not going to change. It's going to fluctuate based on an email you get from your favorite broker who shows you that a building that you think is way shittier than yours just sold for 20% more than you thought yours was worth, or the other way around. So now you
Yeah.
feel good about yourself. And then, or some other, there's always never ceases to amaze me how you get older, you see these things. A younger group enters the market and sees something maybe you don't see, or maybe they just have a different horizon than you do. But then you see a portfolio of buildings that you never thought that family would sell, and it's on the market. But you know what? I always say this too. I can't afford to buy my buildings. They're too valuable. It doesn't mean I want to sell them and, in our the socialist Canada, pay a massive tax and then look for somewhere to deploy it, although maybe in your fund. But, you know, so yeah, looking forward, I think apartments will continue to outpace other similarly priced assets, and the tax advantage is there.
Yeah, well, and if you speak to a lot of these builders, I mean, the cost of building, maybe labor's come down, but like when people are like, well, the cost of homes need to come down. It's like for new builds, is to go speak to the developer. I mean, and year one, so you would get it. It's like to build it, you got to be able to make it profitable for you to build. So a lot of developers, like I asked them, like, what if you get a really good deal? It's like, I'm not building at any cost right now, anything, because just it's too expensive to build. The cost of getting it off the ground is just doesn't pencil out anymore. So um, it's pricing has to come up, in my opinion, in order for these developers to build, so it actually makes sense. It's just going to be a matter. I think right now it's like confidence is a big one, and hopefully a little bit of certainty with tariffs, and if rates do drop, a couple quarter points. I think it's really dependent as well in the asset class. Like you got single family homes. There's not a lot of overdevelopment in Ontario on that. So, and so
Yeah,
I think pick your asset class, right?
absolutely. And I couldn't echo their sentiments more strongly about not being able to profitably construct new housing. I mean, again, I'm not pricing jobs on the monthly basis like perhaps some of the other some of the big guys out there. But I hear things and I read things, and yeah, you're not being able to build for the most part at a price. that is less than what it's worth, and if you can find a buyer. Certainly not in the high rise sector. Perhaps in perhaps the low rise, perhaps in mid rise, perhaps in jurisdictions where there aren't the same punitive development charge and other fee um, costs that are massively affecting the cost to construct in total. That may come down, although it's hard to see it coming down. But certainly development charges in Toronto, I believe on the average new condo unit are like was either 250 or $300,000, some insane number. And if you add everything up, yeah, it doesn't work. It worked when prices were going through the roof. What I chuckle
Yeah.
at and is there are a lot of development groups here that were capitalized in funds where they were going to do a condo, and it was very challenging and difficult undertaking, but there were plenty of groups that had that competency because they had the capital, so they had the balance sheet and the credit lines to back it up. They had relative certainty on the rezoning and entitlements that they needed to build, and they could get the pre-sales, and then the very deep labor pool of good general contractors. I'm sure I'm oversimplifying that process, but it happened to the tune of hundreds of thousands of units over the last decade or whatever it is. So that's reversed for the moment. So a lot of these big guys said, okay, once this is done, the crew's gonna go, take some time off or whatever. But a lot of other guys had funds and they raised the funds. They had to deploy the funds, so they're stuck with very expensive land. So what are they
Yeah.
doing? Well, let me put an apartment building here. And they use this stupid term you've probably heard, purpose-built rental. It
Yeah.
aggravates me when I hear it. It's an apartment building. They were building apartment buildings when my grandfather was doing it in the 60s. These are apartment buildings. I don't know what purpose-built rental, you can give it a moniker if you want, but to me, it sort of signifies purpose-built rental means like I'm purposely not going to make money. So I don't know. The yield on those things to me is I don't know. I've never seen the books on them, but whenever someone else's books, whenever I run the numbers, they don't work. And that was before rates went up and costs went up. So, but these guys are stuck with that land, and what are they
Yeah.
going to do? They can't sell it sometimes. So that
Well,
maybe they're going to do it and hope the market turns around. I mean, we'll see, right?
yeah. Well, this is where the government, going into kind of the socialism kind of side of it, is that the government stepped in with CMHC and they offered these, high leverage, low interest, long amortization loans where the deals don't make sense unless they take these CMHC deals, right? And so that's where you're right. Like, and it totally goes against the rule of like over leverage. And so it's interesting when you look at that because those are pretty much the only things that are really getting built right now. Like you call it purpose-built rentals, right?
Yeah. Oh, hey, listen, if you got 95% money from CMHC at a very attractive interest rate, I get it. But to me, you're still only getting 3.95% yield on your development, even though your cost of money is 2.5. To me, that's just not enough of a risk in that asset to put a shovel in the ground and take tens of millions, if not more, risk with capital, and that you have to pay back. And again, but that's not my um, that's not our structure. That's not our game plan. So yeah, I respect it, and it's I heard someone say in Alberta there's going to be a lot of those that are just not going to they're not going to cash flow. They're not going to be able to service that debt. And I don't know. I believe the construction debt is recourse. The takeout maybe is not, but you're certainly risking your capital that you're investing in it. So hope it works out. I don't know. I have a building in Calgary, and I laugh when I hear Calgary is a hot market, whatever. I mean, I bet you my building today is worth the same or maybe a little more than I paid in 2007. You know, if you ask me, yeah, and rents went up, and maybe it's worth a little more. I don't know, but it's not a hard market. It's a this market, and are things on the way up now a little bit. It's not a deep
Yeah.
market, and people listen, not to discount it. People living there, I'm sure that the sharks on every street know exactly which deals to do and who to deal with and who not to deal with, right?
Yeah.
But we went in and out opportunistically. Very happy with my building. I have a third party manager there. She's wonderful. I hope she never retires.
Hmm.
We'll see.
Very cool. Well, Jason, I could talk real estate deals with you for a very, very longer than we've been talking, but I want to make sure to honor your time. And we have three last questions in rapid fire kind of approach, and then we're going
Sure.
to wrap it up. You ready?
Let's go.
All right. So I'm a big reader, love reading books. I'm curious, which book has made the biggest impact in your life or in your career?
I've read Meditations by Marcus Aurelius twice. Both made a point of completing that. It's almost like a pamphlet before my each of my sons was born, and it has a real impact. It sort of goes through the mind of the Roman emperor almost 2,000 years ago, and sort of the daily thoughts and encounters that he has, and how similar they are to life today. Someone on that scale, and how he doesn't take himself too seriously, and how he seems to be gripped by living as mindfully as he can, and with an awareness of how short our existence is, and how to really just stay in control of things we can control and let go of things we can't control. And that philosophy applies whether it's a deal you're working on, or family health, or personal health, or any other issues, or you know things that you just have to accept. So that's a big one. I mean, I read as much as I can,
Yeah,
mostly business books
I
these
love it.
days, but that one stands out.
Yeah, that's great. And isn't it a beautiful thing that an emperor in Rome, at kind of the peak of its time, he actually wrote down a letter to you if you choose to read the book, right? And it actually, because I know the book, I've been told about that in the past, but I haven't actually read it. So this is why, I'm like, oh, I got to read the book, right? But that's what I love about reading is, and now like been starting to listen to founders as podcasts where they actually get into the biographies. I
Oh
don't know
yeah,
if you,
sure. I think
yeah,
the
yeah,
LMVH guy was on
amazing.
there, right? Bernard Arnault, I think that was a really good one.
Okay. Yeah. No, I'll have to watch. I have to listen to that. But very cool. Okay. Second question. 3 words. 3 words that best describe you, that others would maybe say about yourself.
I'm loyal. I am reasonably intelligent. I guess that's 2 words.
Oh, intelligent. Got it. Yeah.
Yeah, and I'm very devoted.
All right. And final question is, what final advice would you have for the listeners out there, the entrepreneurs out there, that you think would help them most?
I think it's a great time, given the advancements in technology, the ability to do things remotely or in person. Those options that exist that didn't exist when you and I were young. I think it's a great time to formulate your thesis. And certainly, if it comes to real estate, there's so many different ways to really come at it. And this is an asset class that is not going anywhere. Has been around for millennia, and can really generate amazing returns and amazing experiences. So if it's real estate that you like, just dive into it, but make sure to cut your teeth somewhere where you can learn. And if it's not real estate, then the same thing goes. Like, you got to put your head down. You got to be prepared to work. You got to network as much as you can, and it doesn't hurt to have a lot of luck on your side. But sometimes luck is the intersection of effort and opportunity, right?
Yeah. Yeah. I like that, at the intersection. I never quite heard it that way. That's good. That's really good. All right, Jason. Well, really appreciate you coming on the show. Do you guys do any third party, or is it more your own assets that you oversee? Right. And I'm just thinking for the listeners, if they wanted to find a little bit more.
Yeah, in Toronto, we would certainly consider it. My staff, we've been offered a few portfolios that we've declined, kind of adjacent to our own, but my staff would love to do more, and we're structured that way. Outside the city, yeah, it wouldn't make sense. Although, if we ever get larger enough in other markets, certainly something we consider. But yeah, third party management, and then beyond that, if people have, I'd encourage anyone that has an interesting deal to bring it my way, or looking for a capital partner, or even just a straight up equity partner. We're definitely ready to do business in America primarily, but more so in Canada too.
Is it Beaux Properties, BEAUX properties.com? Is that the best
Yeah,
way for them to find a little bit more and reach out?
that's the site. Yep, and I'm on LinkedIn a lot, so you can spot me there, no problem.
Very cool. Well, Jason, really appreciate you coming on the show. Time just flew by. We went over a little bit, so really appreciate it. It was a great conversation.
Thanks, Mark. It's been great.
Yep, right
Take
on.
care. Hope to talk to you soon.
Yeah, talk to you soon. Thank you, everyone, for coming on the show. If you liked it, you can go ahead and subscribe to the channel. And moving forward, guys, one of the best ways to build your wealth is to grow your business and invest in real estate. Love you guys.